All right. Dear friends, this is Vinney Chopra again. As you know, I come live. Well, I don't come live, I record live, but some of you have read my book, Apartment Syndication Made Easy, which became top international seller. And actually, we have 325 positive reviews, 5-star, 4 to 5-star reviews across the world, actually, in Canada, in Italy, in India, in Australia, in UK, I mean, you name it. So thank you for, and this show that I do 5 shows a week, by the way. Some of you might like to catch me on my other shows, motivation show, my senior living show. Then I have Bo and Vinney show on the loans. And then of course, I'm starting my other show, which is going to be Millionaires Playbook show that's coming up. But the exciting part is that I'm doing the things, what I talk about, what I teach and preach, I do them. So this is the sequel to this one podcast. Please like us, subscribe to us on YouTube channels or iTunes, and give positive reviews so that we can bring great guests like my next guest right here, Dugan Kelley, a very known personality in USA as the top SEC attorney. And we need to make friends with them because they keep us out of jail, out of trouble. So thank you, Dugan. Welcome to the show.
Thank you, Vinney, for having me. Hey, everybody. Happy to be here.
It's so nice to have you. I want to tell a little bit about Dugan. Dugan Kelley is the co-founder of Kelley Clark PC, a private firm that has assisted clients in structuring the real estate transactions in excess of $2 billion with a B, $2 billion all over the USA, providing syndication and the security services for clients in all phases of their acquisitions. And Mr. Kelley brings massive expertise, having over 20 years of experience, and is also an adjunct law professor. All right, we are talking to a professor who's going to teach us today in simple terms. Looking forward to that. And his accomplishments are vast, and that, we'll dive into it. And Dugan, grateful to have you here with us today. And I know you have 3 daughters, and you live in Dallas, and you grew up actually in Montana, kind of.
That's right.
Your life, bud, a little bit, yeah.
Okay, so I thank you, Vinney, for having me again. I was born and raised in Montana. Like you said, I have 3 sons. They're
sons.
Yeah, sons. So boys, they keep us hopping. My wife has way more grace on me than I have in the process of raising young men in this day and age. So we have offices in Dallas and in Santa Barbara, California. So that's a small city about 90 miles north of Los Angeles for people that haven't been to Santa Barbara. It's an amazing place. And I split time between our offices, between those 2 offices. But most of my clients are like you, Vinney. They are hunting for properties around the country, things that would be amazing opportunities for their investors. And so I've been blessed to be able to represent a lot of syndicators over the past few years in structuring their deals, both the real estate and the security side. And so I really believe, like you do, and it is one of the only avenues to be able to provide financial freedom for people that are looking for that. So I'm very thankful to be doing what I'm doing.
Thank you. No, you are so true. I mean, real estate, I know our audience, they know that how successful people have become and how great cash flows and equity gains can come about in real estate investing and so on. Of course, you got to really see who the operators are. You want to make sure that the legal paperwork is fully taken care of. You want to make sure that the syndicators and their track record and everything, how they met you, how they went through all the different sequences. So we're going to talk about all that. So let me ask you, Dugan, what are the pitfalls that you see for some new investors or syndicators?
Yeah, so I think one of the biggest pitfalls for investors, for potential investors, is not really understanding the deal, right? So what is when we say waterfall, what does that really mean? What's the plan of distribution? So when I'm representing an investor, I'm looking to invest, I'm looking, what am I buying? Like, what's the item that I'm buying? How much does it cost? And when can I expect to be paid back? Those things, having a very thorough understanding of that operating agreement are key indicators for any investor. And so what I see oftentimes are like what you said, Vinney, investors who don't vet the sponsors or the syndicators. Yeah. They don't look at the track record. They don't check on references. Yeah. They don't understand the deal structure, and they just blindly give their money away to somebody with the expectation that at some point it will return to them, or they'll get a return on their investment. And that's not a good way to operate or invest in these opportunities. So I do see that those are some of the pitfalls that I see, that I'm sure that you see as well.
So true. So very true. You know, Dugan, I mean, the key thing is, I think I got attracted to this field of syndication 14, 15 years back when I became broker in California. I never sold or bought a single property in my life, but I became broker, and, you know, my wife, we were in single family homes, and we wanted to scale up and make a generational wealth, so as to speak, you know. But syndication world is a great, great world for the transparency. I love it. For also to be able to totally give the real structure of the deal and not making promises that you cannot deliver. You got to be conservative. You got to underwrite. You got to find the right deals, not just keep on doing deal after deal after deal. Because if it's not the right deal, then don't do it.
I totally agree. Sometimes the best deals are the ones that you don't do. Sometimes the best deal is the one that you never invest in, because, you know, it's got to be a good fit. You really have to be able to do your due diligence, just like an investor. You want to be able to do your due diligence.
So true. And you mentioned about operating agreement, which is so true. Of course, in the whole package, those of us who are, you know, kind of watching us, 506B and C, I hope you know what we're talking about with the exemption D and all that, right? Regulation D. So the key thing is that operating agreement is very, very important. How that LLC that's going to purchase the property is going to be run. And the PPM, private placement memorandum, will show you what the risks are before buying it. And then subscription agreement, the third part, is again making sure that you get the right title, you know, right entity that is going to invest, and make sure that you are, you know, listening and reading everything, if you're accredited or sophisticated or non-accredited. And now there is a new language too, by the way, right?
Yeah, that's right.
So kind of share with us, you know, I mean, what should a passive investor look for? You know, should they get into a joint partnership, which some people try to save money in syndication? I go against it always, you know?
Yeah, so I mean, you're absolutely right. There's usually 6 ingredients to every deal. Okay, it doesn't matter if you're looking at investing in a small franchise, or you're looking at buying a $50 million apartment building. If you don't have a document, the PPM, when Vinney says the private placement memorandum, that's just a big, broad legal document, usually a couple hundred pages thick. It's composed of various components. The first component, like Vinney mentioned, are all the risks, right? If you're going to invest, you want to be able to transparently, authentically, honestly tell your investors all the risks associated with the investment, because there's no guarantees in investing. And so we want our investors to know that. The second part is, why am I buying this? Like, what am I buying? The marketing, like, what's the business plan that's going to be implemented by the sponsors of the deal? The sponsors, the syndicators, those are often interchangeable terms. And then I want to know, like Vinney said, is this a suitable investment? So the SEC looks at, is this a suitable investment for somebody? We often use what we call questionnaires for potential investors to find out, are they an accredited investor? Could they tolerate potentially losing the investment? Or do they have sufficient liquidity or net worth such that they fall into what the SEC calls an accredited investor? Or are they a sophisticated investor? Somebody by life, experience, expertise has enough to properly evaluate the merits and risks associated with the investment. And if they get past that suitability process, that subscription agreement, that's just a legally binding agreement that says, hey, if Vinney has a property, he's selling you this and you are buying this. And then last, but most importantly, is that operating agreement. Because once the deal closes, right, the PPM and all the other documents are basically done. And the only agreement that you have with that sponsor, that syndicator, as a passive investor, on what rights and obligations you have, capital calls, putting money in, pulling money out, selling your shares to somebody else. That's all inside of that operating agreement. So you want to make sure that you have those ingredients in any deal that you're looking at. If you don't see it, if you don't see one of those ingredients, it's not a right deal for you, because every deal should have all of those things included in it.
Awesome. Awesome, Dugan. So nicely said that. Thank you so much. Again, I want to also take you into the TICs, take you to joint partnerships. Could you kind of throw light on that? Because as I understand, 15 years back, syndication is if somebody entrusts and gives me money, even my friend gives me money, and I'm making decisions on a daily basis for the profit of the business that I'm investing that money in, it's a syndication. Even two people, it's a syndication. Is that right?
That's right. That's right. So many people think that they could just do a joint venture or a partnership and avoid this whole thing called securities. Like, I don't understand what this is. I don't want any part of it. So let's just get together. You give me some money and I'll give you a return. Well, that's the sale of a security. So the rule of thumb is if the person giving you the money is expecting a return on that investment and you are raising equity, that is a sale of a security. It doesn't matter if it's a husband and wife or children or family members, or if it's a penny or $1 or $5, the sale of a security is the sale of a security. And so I agree with what Vinney said, that if somebody says, if you could just avoid all this stuff by doing these joint venture partnerships, that's not necessarily true. You should really look into that before you actually do that, because you could get yourself into some hot water, so to speak, and you don't want to be there when the problems.
But there is the legal structure TICs, right? Tenants.
Yes, there are.
Would you kind of explain that? That's a different.
I will. Yeah. So there are a lot of people that have sold properties, and they need to defer the tax gains on those properties. Those people, you might have heard, they're called 1031. 1031 just refers to the IRS code section 1031. And what that basically says is, if I immediately don't take possession of those gains, those funds, and I am able to redeploy that money into another opportunity of equal to or greater value in real estate only, then I'm able to defer those tax gains, meaning I don't have to pay Uncle Sam any part of the profit that I made on the land or the property that I just sold. If you're going to do that, one of the compliance structures for syndicators is to create what Vinney is calling a TIC. A TIC refers to not little bug that gets in your hair, Ned. It's a tenant in common structure. So that's the acronym. Tenant is the T, in is the I, and common is the C. So the TIC structure is how you can have parties that have 1031 money essentially redeployed alongside of syndicators into a deal. And for a long time, people said couldn't be done, can't do it, or whatever. So I started talking years ago at conferences for clients and masterminds and meetups about, no, we can. This is not something new. I did not invent this. This has been around for hundreds of years. We actually inherited it from our cousins across the pond, from English common law. It's been around for that long. So the concept is a very good concept for syndicators and operators that are looking for diversified streams of capital. So if you're somebody that is looking to essentially either accelerate your raise, meaning you're shrinking the amount of equity that you need in order to obtain the loan, in order to get the keys to the apartment building, I think you should think about, certainly look at that 1031 tick strategy. But you got to be careful because the 1031 parties are not just passive investors. They're not your investors.
Yes.
They are alongside of you. They are a co-owner. They own an undivided interest in that real property. And they do have voting rights that are unique to them that your passive investors do not have. So you got to be very careful with who you align yourself with, because this is often a relationship that will exist for years, right? And we've all had those bad relationships. You don't want a bad relationship. You want a good relationship for years. So you want to make sure that that works.
So true. So very true. So ticks actually, I've done only one tick, by the way, of 750,000 my friend brought in. So he was able to own 22% of the apartment complex, because you got to give a percentage of ownership to the tick. And of course, then he also had to be on the loan. Is that right? Let me ask you.
That's right.
Huh?
That's right. So there's two major ways in which agency lenders, when we say agency lenders, we're saying Freddie, Fannie, or HUD. So Freddie Mac, Fannie Mae, or HUD that allow, or even bridge lenders that allow parties to participate. One way is in which there are non-member managers. So for instance, let's say a syndicator says, hey, to the lender, I have a bunch of 1031 parties. They really don't want to be active. Yes, they have to own an undivided interest in the real property, but they don't want to be active in the day-to-day operations of this. And they're not necessarily interested in being underwritten or having to sign on the loan. What can they do? And so some lenders will allow, and this is a lender specific issue, some lenders will allow parties to be managers of an entity in which they don't own. So the syndicator that owns and operates and manages the syndicated entity will often not own the 1031 entity, but will manage that alongside the 1031 party. So your friend, for instance, he comes in for $750,000 in that deal, and you might be the manager of his entity as well as him. He would be the sole owner, because you can't own any part of his entity in order to protect that 1031. But that's one way. The other way is what Vinney's referring to, and that is everyone that participates as that 1031 level has to be underwritten by the bank, will sign on the guarantee and the loan documents, even if their fractional interest of the real property is 1%, a half a point, 2 points, 3 points, doesn't really matter. If you're a co-owner, you're also a co-borrower, your name is going on the deed, the bank is going to expect that you're signing on the loan documents. Otherwise, think about it practically. Let's say you have a 1031 party that has 5%, but they refuse to sign the loan docs. They could go out and borrow more money on the 5%. And the bank is exposed. So you've got to remember, the bank is the biggest investor in all of these deals. The bank always has the most skin in the game, so to speak. So those are the two ways in which you're seeing lenders allow parties to participate using 1031s and ticks in particular.
I love it. Love it. I mean, Dugan, you explained it so nicely, but that's fabulous. Let's take the other way out now. So in other words, now we are selling the property and there are a bunch of investors who don't want to pay the taxes and they want us to take 1031 out when we sell the syndication, dissolve the syndication, we call it, right? So
that's right.
Yeah. So it's kind of share with us, how do they take it into a next property? Can some cash out and some can go along with the LLC?
So there's historically been two avenues or methods for people to do that. So Vinney's correct. So when you're a syndicator, you're often like herding cats, right? You've got lots of different investors. It's very common to see syndicators essentially say to themselves, hey, we're cashing out, we're selling the property, here's your distributions, and everybody pays their tax. Okay. That's the most common scenario that occurs throughout the country.
Yep.
But sometimes that isn't what some investors want. Some investors are fine. They don't need the cash. They like the tax benefits. They like the cash flow, but they don't necessarily want a big chunk that they then have to pay capital gains on.
Sure.
So theoretically, they will do what's called a drop and swap, which means a new entity will be created. The investors that want to cash out and pay their taxes will transfer their interest into that new entity, and that entity will receive their equitable distributions at sale, and they will pay their taxes according to what it is. And the old entity, the original entity, will transfer into an exchange, well, a qualified intermediary, and 1031 into the next property. So that's the dropping some people into an entity and swapping into the other one so that they actually pay their taxes. So that's one method. There is another method that some qualified intermediaries are using. It's called the Promissory Installment Note method, or PIN method, in which investors are allowed to essentially receive installments over time, the people that wanted to get out, and they'll pay taxes on that. But that also allows the same entity, the original borrower, to 1031 into another opportunity. So there are multiple ways in which you as an investor could potentially defray capital gains tax and get into another opportunity. But it's not without complexity and having to kind of walk through that process. But absolutely, they're out there.
Sure. Dude, isn't that also true? Because we are really the LLC that took the loan, so as to speak, we are changing the structure at the time of sale. So
that's right.
We have to do these things in a sure way that the property is going to sell, and because the lender can call the loan. The term is calling on the loan, right? So what time frame and all that? Could you kind of advise us on that? How should we do it? Yeah.
It's very quick. So, I mean, it's like any of you that have invested or are syndicators, operators, you know that when you're getting up to closing, whether it's a sale or an acquisition, everything is crazy, right? It's hairy. There's lots of emails flowing around. People are asking for signatures. You're getting notaries running around, trying to wire in money, trying to invest in things. It can seem like a lot of organized chaos, if you will. So when you're doing these types of things in 1031 and dropping and swapping, it's the same kind of mechanism. You don't want to do it too early because you got to go get the blessing from the lender, right? And what happens if the buyer for your property doesn't close, right? So now you've got a new entity. You put some of your investors into that new entity. Now you've changed the structure to a TIC structure, and you're going through the process of consenting with the lender. So from the lender's perspective, they want to know this is serious, right? And some lenders may not consent, right? Because under the loan agreements, just like Vinney said, they can call your loan. And you transferring some of your interest from the borrower, the original borrower, to a new entity is by nature under the loan agreement a violation of the loan agreement. Hence why you always want to inform your lender and get their blessing and their consent to let them know, hey, we have passive investors. Some want to continue on, some want to cash out. This is what we want to do. So generally speaking, the timing is around 30 to 45 days before closing. So you don't do it too early, but you can't do it too late because of all the moving parts.
So true, so true. Awesome, awesome. I hope everybody's really getting great gold nuggets, guys. And if you like the content, please subscribe to the YouTube channel and also to the iTunes. Go ahead and give 5-star reviews and also share this episode with your audiences. Again, this is Vinney Chopra. We'll be right back. All right, Dugan. Yeah. So let's talk about, thank you for your time. I really appreciate that. Let's talk about money raising. I know that has become so popular. and a lot of people are doing it wrong. Could you please throw some light so that we can, really, teach? I mean, that's what I feel. Our audience sees what's right, what's wrong, so that they don't end up in jail.
Yeah. So the bottom line is, if you're going to raise capital for a deal and you want to be paid for that deal, whether it's a piece of your acquisition fee or asset management fee or even back-end equity, these are often terms called the promote, right? So for people that use that term interchangeably with our acquisition fees or back-end equity, the reality is, unless this is your deal, you are a sponsor of that deal, you cannot get paid for it unless you are a registered broker dealer or affiliated with a registered broker dealer. Right. But this just in, right? October 6th, for the first time for 15 plus years, the SEC is starting to move at a glacial pace to actually reform some rules and regulations regarding raising capital. And so they are introducing, and it's not final yet, so it hasn't been approved yet, but they're introducing this concept that there could be individuals out there that fit this model of being able to raise capital and be paid a commission, right? Just like a broker dealer, a registered broker dealer could be paid a commission on the amount that they raise, even though it's not their deal. That historically has not been the case. There was a very limited finder exception, which really meant a flat fee for basically making an introduction and doing nothing more with investors for the deals. But in large part, practically speaking, that's not real life, right? So the vast majority of people that are interested, that know, like, and trust Vinney, that may want to potentially raise capital for Vinney or another operator, but they don't want to be participating in the general partnership or a sponsor. They want to be able to introduce people or even potentially say, hey, here's an offering and get paid for it. That is something the SEC is seriously looking at. And I'm hopeful that it will pass. I think certainly it's going to come with a lot of regulations that you're going to, and rules that you're going to have to follow. But provided that you follow the rules that the SEC is going to set up, you will be able to essentially raise capital for potential deals, provide notice to the SEC that this is actually happening, and receive a commission, something that historically you could not do.
Yes,
you could not do. And so I think that is a very, very positive step, in my opinion, because, and the SEC finally has recognized the vast majority of people in the country that are syndicating, right? They're not rich. They're not giant corporations. They don't have access to these capital raising broker dealer entities or individuals. And so they are left scrambling, trying to find anyone that could potentially help them, because private equity, I really believe, is the fuel that fuels the American economy. So small businesses largely depend in this country upon private equity. If you don't have the ability to pay somebody to help you raise that private equity, and the only way they can receive any form of compensation is actually be a member of the GP or in their deal, it cuts off a lot of opportunity for people to do things in a legal way. And so I'm grateful that the SEC is honestly taking a very hard look at how to modernize this concept of having people out there who identify themselves as a finder of capital, and them actually being able to be paid fairly, competently, legally, and transparently for that service.
I totally agree, Dugan. And again, I can see SEC's thinking also that they don't want people to pressure.
That's right.
Word pressure, of their relatives or friends, and not really showing them the real risks involved like we
Yes.
discussed in the PPM and everything. I think it has to be very, very authentically presented,
Yes.
and we need to make sure that we have the right guidelines to follow. I really believe, I think what you're saying is so right. I think there are people who can help other people because we
Amen.
did not know them until there was that person in between who knows that their relative or friend or people at work have money in stock market or other places, right? People do give consent and they give advice, right? They are not CPAs, but people do take that advice, by the way, and they
Yeah.
end up investing. So you're right. I think by having more transparency, by having all the risks are shown to the investors and keeping the syndicators and our partners, our finders, true, with the honesty, I think is the word, because we need to
Agreed.
make sure that we don't take the last dollar. That's the problem I
Yeah.
see, because sometimes people say, this is the only 50,000. We should never take that 50,000. I tell my students and everybody, you got to
Agreed.
they need to have at least 10 times more. Is there a rule or anything like that, by the way? No.
It's not a rule, but when you're not a sophisticated investor, if you cannot tolerate the total loss of your investment.
Yeah.
So as Vinney said, if you've only have $50,000 in your IRA or in your bank account or something, and the minimum investment is $50,000, this is not a suitable investment for you. You need to have sufficient liquidity or net worth and a level of sophistication that says you can weather the bad times as well as the good times, right? So we obviously we are projecting and we want everything to always be awesome and run very smoothly. But the reality is that's not life. Life is full of ups and downs. And so you always have to have a positive mindset. But the reality is, if you're talking to a potential investor and that's all they have, don't take their money. It's not worth it. It's not a suitable investment for them. You don't need to do that.
So true, Dugan. And again, we want our investors to sleep at night nicely.
Amen.
They know that their money is safely put, that they are ups and downs, like you said, but they don't want to be at your door. And, after the syndication just completed, I want to sell my shares. Or, I've got hardship coming up now and I need that money. So I hope everybody listening to us, you've got to really make sure that you are building, your investor base and everybody with, the people who can afford and who are more savvy about investments and things like that. Definitely. What other pitfalls, Dugan, do you have given so many great nuggets. I appreciate your time, brother. That's awesome. And I was so impressed that you said, Vinney, when I had the meeting, I'll provide you PPM, subscription agreement, and the operating agreement in 1 week.
1 week.
Oh my gosh, let's talk about it. Oh my gosh. I will like, audience to really call. Dugan, how can people reach you, brother? Yeah.
So thankfully, I was blessed with parents that gave me a very unique name. So you can always plug me into Google. You can Google Foo and find me. So my first name is Dugan, Dugan, at Kelley, Kelley, Clark, CLARKE.com. That's the name of my firm, kellyclark.com. Find me on the internet. Feel free to call me, email me. Happy to chat with you about how we might serve your needs.
Beautiful. So, like 7 days, I mean, I love it. You're so organized, your team and everybody, who works with you, and you are right on the forefront with, when we just did the $35 million deal, I was so impressed,
Thank you,
tell us, really. And so it's very good because, you've done it, for so many syndicators and things like that. What are some things that make you do it so quickly?
Well, I think understanding what the client's looking for right up front. So, and then it's a total team effort. So I am just one person, a part of a larger team. inside our firm, and we're always dedicated to making sure that we can service our clients' needs. So, I can't do it alone. I might be able to serve so many clients alone, but the reality is, just like syndication is a team sport, takes a total team effort. The practice of law, certainly in the securities and the real estate realm, it takes a team effort as well. So I give all the credit to my team. They make me look very good, despite all of the stress of various deals that go on throughout the year.
Totally, Dugan. I want to take and give kudos to my team. At the peak, we had 135 people in my
Wow.
team, different, because we are vertically integrated, Dugan. So we have managed all 28 assets that I bought, and now senior living also we manage. So that's 35 syndications. But having the VP of accounting, VP of finance, VP of investor relations, VP of acquisition, VP of all that. Those are the people I really want to give thank you. And then the community managers, and then our, so many great affiliates, members of our team. I just am as the face. You're right,
Yeah, right.
But to have the great people, because people make the companies, not the walls, not the structures. I always feel that. And that's what it is all about, sharing the vision and everything. And then, automation is huge, of course.
Yeah.
Also the systems, right? Yeah. We put great systems in place that free up our time. Like I do 7 interviews every 2 months, like this in one day. Then I don't know what happens. It's gone. And then they all show up on the LinkedIn and Facebook and all, in the right times. No, it's really great to, build. What's your thinking on 2021, if I may take you there as we wrap up our session,
I'm bullish. I am very, very bullish. I think, we're still seeing the bridge lending. When I say that, bridge lending, very sluggish, right? But it's starting to come back. But agency debt, Freddie, Fannie, HUD, and loan assumptions are getting done. So for those of you that are operators or passive investors in commercial real estate, you understand the fuel that kind of helps the industry is debt. Yeah. And having lenders that are willing to loan money and flip properties, buy and sell properties. That's what makes our industry hum. And so I am very thankful. We had a couple months where we're a little sluggish and slow, but we're coming out of it. And I think this third quarter of 2020 has been amazing. And I think the first quarter and second quarter, even if there's a little bit of price compaction in the single family residential space, we're not going to see that necessarily, in my humble opinion, in the multifamily space. People have to live somewhere. They don't all have to work somewhere. So people are always going to be in high demand for multifamily, for apartment buildings. And so I'm very bullish on multifamily. And that's not just because I am an investor, syndicator, lawyer in the space. It's because it's just what we are seeing. So for seasoned investors, you're seeing still returns very substantial in the area of multifamily.
So true, Dugan. And, I did the show this morning, which is our senior living investing show, which we have really gotten into. And I'm a senior myself. The exciting part is that there is such a big need. 24,000. Hold on. 24,000 negative every year that we need in the senior housing with the silver tsunami going on, right?
Yeah.
1,000 baby boomers are turning 65 every day, every night, midnight. So you're right. I think multifamily also, again, really didn't take that much brunt in the 2007 and 8 recession, which we are going through recession right now. But people need that roof over their head, like you said. From single family, they might move to A class, or B will move to B minus, and C will, B will move to C, and so forth like that. So it will be great opportunities. And like you said, the contraction of the, price. It's been kind of overstored. What should I say? Well, demand was much higher than supply because a lot of expectations went up, in 2018 and 19, and then now with COVID, with the, toxic, I call it, on the rent roll, with the moratorium coming up and things like that, when it's lifted, we'll see some P&Ls kind of downward. NOIs will be lower. So there'll be great opportunities. There's a lot of dry powder out there from the to put it in and all that. No, thank you. Thank you so much. It's such a pleasure. Dugan, thank you for taking the time, and love to, if you start your show, I would love to be there and, promote.
Absolutely, Vinney. You're so gracious and wise. Thank you for having me.
No, thank you so much. And again, guys, if you really like the content into this show, please don't forget to subscribe and comment, and also share this episode within your circle of friends and relatives, everybody who could really get something out of it, so that you can also be sure to give us the 5-star reviews so that we can bring great guests like Dugan Kelley and great celebrities on our show. So thank you so much for watching. Have a blessed day. Thank you, Dugan. Appreciate
Thank you.
Thank you so much. Bye-bye.
Be sure to listen to Mr. Smiles next week with more golden nuggets and top-notch coaching tips. You can reach him by going to VinneyChopra.com. Be sure to like, comment, and share to show everyone how Mr. Smiles has brought your apartment syndication business to the next level.